Are you an entrepreneur making less than $100,000? Well, today I'll be talking about tax strategies you can use in your 2018 taxes to help you save money. Let us talk about your 2018 tax planning. It's almost the end of the year. It's time for you to start thinking about this. This episode right here is just dedicated to entrepreneurs making less than $100,000. So if you're making more than that, there'll be other episodes for you. And in this episode, I just focus on your tax structure because as an entrepreneur that size, that's the biggest place you save money. In this episode, there are three main tax structures I talk about, which is the sole proprietorship, the partnership, and the corporation. We will see how being structured in either of this can save you or cost you money. Now, looking at the three different tax structures as mentioned earlier, the Schedule C, also known as sole proprietor, the 100K S Corp, and the 100K C Corp, we see that the S Corp has the lowest liability at $11,894.34. This is after paying wages of $35,000. Now, as an S Corp, you do have to pay wages. For the C Corp, it's lower than the Schedule C, and we can see the tax liability is $15,569 as compared to the $24,313 for the Schedule C. Now, this is due to the reason why this is happening is because of the new tax rate, the lower tax rate for corporations, which is at 21%. So we can really see this change taking effect at higher income levels, like income levels that are above the 21% tax rate. That's where you see the most savings. So now let's talk about the new business deduction called QBI. You've probably heard a lot about this in the media. What is that? The qualified business income deduction is 20% of your QBI income. For most people, it'll probably be like their net income, but sometimes, depending on your type of business, some adjustments might need to be made. If you're below $157,500, since I'm talking to entrepreneurs who make $100,000 or less, there are no limitations or no specifications that really apply to you. But as you begin to go above that level, you will see how little changes you make changes your amount of QBI deduction. So let's take a look at how this looks in our comparison. Let's look for the QBI deduction, which will be for your taxable income. So here we can see the QBI deduction for the Schedule C was $16,187. For the S Corp, it's $12,380. Now, the S Corp has lower QBI. The C Corp does not have any QBI deduction at all because as a C Corp, you already get the lower tax rate because the intention of the QBI was to make up for the 21% lower rate that C Corps get. So that deduction was given to pass-through entities so they can level the playing field. Now, even though the S Corp has a lower QBI, and that's because it has lower business income, it still has lower tax liability. So when you're looking at QBI, I know this is new and this is big, and pretty much everywhere you go, they're talking about this. You don't want to look at it in isolation. You don't want to be like, oh, I'm going to do this because that will give me the biggest QBI deduction. Well, no, because you might get the biggest QBI deduction, but it might cost you in something else. So when you're doing tax planning, it's best to do a comprehensive to see how one change affects the other. And just to mention here, as an S Corp, you do have to pay yourself wages. So do not think that you can skip paying wages to get the higher QBI deduction. That will be very, very frowned upon by the IRS. Now let's take a business owner still making less than 100K or less, but yet has 2 children. So it's filing head of household. Now you can see as a Schedule C, the tax liability is $16,666. As a S Corp paying 35K in wages, the taxes become $6,660. The reason it's split like this is because $3,982 is liability on the tax return, and this $26,077.50 is the extra taxes he's going to pay on his payroll taxes. So because that payroll taxes have to be paid out, we do have to take that into consideration. And then the C Corp, the taxes would be $8,086.53. And that's based on the 21% tax rate. Now there's something very interesting here. If we scroll down, we will see that the C Corp actually has a refund on the personal side of $4,913. So the personal tax return, they'll get a refund of $4,913, but they'll pay $12,999 for the corporate taxes. So by the time it nets, they still end up paying more on the S corp. But I thought it was pretty interesting so that you can see that even though they're getting a refund on one side, they're paying the higher taxes on the other side. Now, for a person with children, it's important to note the child tax credit. The child tax credit has been increased to $2,000 for each qualifying child, and this credit is reserved for those who are below 17 years. Now, if you have a child who's above 17 years, or you have other dependents, then you can also get an additional non-refundable, which means if you don't owe any taxes, you don't get it, $500 per dependent. So this is big. That's new for 2018. This right here kind of makes up for the fact that in 2018, the personal exemption has been lost. Another change that will affect small business owners or people in general with children more is the change in the personal and standard deduction change. As you can see, the standard deduction went up. There's a $5,500 raise for single, $11,000 raise for married filing jointly, $5,500 raise for married filing separately, and $8,450 raise for head of household. However, you've lost a personal exemption. So in this case, our business owner has 3 exemptions, him or herself, and 2 children, so that'll be 3 exemptions. So in the old system, this entrepreneur would have gotten $21,700 in personal / standard deduction. In the new system, they're only going to get $18,000, so they're actually losing $3,700. So let's take a look at how this deduction looks on the comprehensive side of the tax return. So here we can see the wages were $35,000. So we scroll down, we see the deduction of $18,000. So that's the higher standard deduction with no personal exemptions. And then we see this family there's a credit for child and dependent care. There's not really much of a change there. And then they also get the earned income credit and refundable child tax credit, which is why they got the refund of $4,913. It is important to note here that in all of these calculations, the assumption is no estimated taxes were paid or no federal income tax was withheld. Now, federal income tax withheld comes from your W-2, and estimated taxes are what you pay quarterly. In the United States, we have a pay-as-you-go system. So what you actually pay at the end of the year is not really your tax liability. That's just the balance of what was not paid during the year. So if you paid $1,000, that's not your total tax liability. If you're not sure what this amount is, take a look at your 2017 tax return. If you're interested in this Excel file, you can download it by clicking the link below. But in the meantime, just let me know what you'd like me to talk about next. Just leave your comment down if there's any issue that's bothering you that you'd like to see me make a video on. Go ahead and leave a comment for me. Also, if you like the content, be sure to subscribe so you get an alert when a new video is posted. And if there's any general comment you have, how I can improve things, go ahead and leave a comment. I look forward to reading your comments. Thank you.